$80 per ounce. That was the number flashing across trading terminals when silver did something it hadn't done in nearly half a century. It broke through psychological resistance like a freight train through a paper wall. And then, within 72 hours, it collapsed so violently that traders across the globe were left staring at their screens, wondering if they had just witnessed the peak of a generation or simply the opening act of something far more significant. This is not a story about charts. This is a story about what happens when the monetary system begins to fracture, when governments print currency like it carries no consequence, and when a metal that has served as money for 5,000 years suddenly reminds the world why it earned that role in the first place. To understand what is happening in silver, you have to first understand what is happening everywhere else. Because silver does not move in isolation. It moves in response to forces that most investors refuse to see until those forces have already reshaped their portfolios. Start with the foundation, the United States dollar. For 80 years, the dollar has served as the world's reserve currency. That status gave America an extraordinary privilege. It could print money to fund deficits, wage wars, and stimulate economies while the rest of the world absorbed the inflation. But that privilege is not permanent. It never was. Today, the dollar faces pressure from multiple directions simultaneously. The Federal Reserve, after raising interest rates at the fastest pace in 4 decades, now confronts the economy showing signs of strain. Manufacturing data has weakened. Commercial real estate loans are rolling over at higher rates. Regional banks still carry unrealized losses on their balance sheets that would terrify depositors if they understood the accounting. And yet, inflation has not disappeared. It has simply changed form. The headline Consumer Price Index may have declined from its peak, but the prices of essentials, housing, insurance, food, healthcare continue to climb at rates that erode purchasing power. This is the trap the Federal Reserve built for itself. Cut rates and inflation reignites. Hold rates and the financial system cracks. There is no painless path forward. This environment does something profound to investor psychology. It forces a question that most Americans have not seriously considered since the 1970s. What is money, and can it be trusted? When that question spreads from academic circles into the mainstream, precious metals wake up. Gold moved first. It always does. Gold is the senior monetary metal, the asset central banks hoard when they lose faith in each other. And over the past 3 years, central banks have been buying gold at a pace not seen since the 1960s. China, Russia, India, Turkey, Poland. These nations are not buying because they expect modest returns. They are buying because they are preparing for a world where dollar hegemony cannot be assumed. This is not speculation. The data is public. The World Gold Council reports that central bank purchases exceeded 1,000 tons in both 2022 and 2023, and 2024 continued the trend. These are not retail investors chasing momentum. These are sovereign treasuries making strategic decisions with multi-decade time horizons. When gold catches a bid from central banks, it creates a floor under price. And when gold rises, silver eventually follows. But silver does not follow politely. Silver follows with violence. The gold-to-silver ratio explains why. Historically, this ratio has averaged somewhere between 40 and 60 ounces of silver to purchase 1 ounce of gold. At its recent extremes, the ratio stretched past 80 and even approached 100. That kind of divergence does not persist indefinitely. When capital finally rotates into silver, the move tends to be rapid and breathtaking. This is precisely what happened when silver touched $80. Years of underperformance relative to gold corrected in a matter of weeks. And then, just as quickly, the correction arrived. Understanding why silver collapsed from its highs requires understanding who trades this market and why. Silver is a thin market. The total above-ground silver supply, while substantial in absolute terms, is tiny compared to gold or financial assets. That thinness creates opportunity for large players to move price in either direction. When momentum builds, price can spike far beyond fundamental value. And when momentum reverses, the descent can be equally severe. The players who dominate silver futures are not long-term holders. They are speculators, hedge funds, and algorithmic systems designed to exploit short-term trends. These participants have no loyalty to silver as money. They are renting exposure, not owning an asset. When silver hit 80, the speculative positioning was stretched to extremes. Commercial traders, the producers and industrial users who actually handle physical metal, were heavily short. This setup has repeated throughout silver's history. When speculative longs become too crowded, the market engineers a flush, and flush it did. Silver dropped double digits in percentage terms within days. Margin calls cascaded, stop losses triggered. Panic selling fed on itself until price found a level where buyers were willing to step back in. This is not a sign that the bull market ended. This is a sign that the bull market is functioning exactly as silver bulls markets always have, with volatility that separates the committed from the casual. Now the critical question emerges. Is silver finished, or is this simply a pause before the next leg higher? To answer that question, we must examine the forces that drove silver upward in the first place and determine whether those forces remain intact. First, consider industrial demand. Silver is not merely a monetary metal. It is an industrial metal with unique properties. Silver has the highest electrical conductivity of any element. It has antibacterial properties. It is essential to solar panels, electric vehicles, 5G infrastructure, and medical devices. The global push toward electrification is not slowing. Governments worldwide have committed trillions of dollars to renewable energy buildouts. Solar installations continue to grow at double-digit rates annually. Each solar panel requires approximately 20 grams of silver. Multiply that by hundreds of millions of panels, and you begin to understand the demand pressure building beneath the surface. Electric vehicles present a similar case. A conventional internal combustion vehicle contains roughly half an ounce of silver. An electric vehicle contains more than double that amount. As electrification accelerates, industrial demand for silver will follow. This creates a structural floor under silver that did not exist during previous bull markets. In the 1980s or even the 2000s, silver was primarily a monetary and speculative asset. Today, it is also a critical input to technologies that governments have deemed strategic priorities. Second, consider the monetary environment. The Federal Reserve faces a dilemma with no clean solution. If inflation persists and the Fed holds rates elevated, the burden on debtors, consumers, corporations, and the federal government itself becomes increasingly untenable. The national debt has exceeded $34 trillion. Interest payments now consume more than $1 trillion annually, exceeding the defense budget. Every basis point of higher rates adds billions to annual deficits. If the Fed cuts rates to relieve this pressure, real interest rates could turn negative once again. And when real rates are negative, when the interest you earn on cash fails to keep pace with inflation, there is no opportunity cost to holding gold or silver. Physical metals suddenly become attractive to capital that previously parked in money market funds. This dynamic explains why gold has performed so strongly even with rates elevated. Smart money understands that the current rate environment is unsustainable. Either rates come down or something breaks. Either outcome favors hard assets. Silver, being the more volatile of the two monetary metals, offers leveraged exposure to this thesis. If gold moves 30%, silver historically moves 50 to 100%. That leverage attracts capital when conviction builds. Third, consider geopolitical fragmentation. The post-Cold War era of globalization is ending. The United States and China are decoupling economically. Russia has been largely severed from the Western financial system. BRICS nations are actively exploring alternatives to dollar-denominated trade. This fragmentation has direct implications for precious metals. When trust between nations erodes, the appeal of a neutral settlement asset increases. Gold requires no counterparty. It cannot be frozen, sanctioned, or devalued by decree. This is why China has been accumulating gold aggressively while simultaneously reducing its holdings of U.S. Treasury bonds. Silver benefits from this trend as well, though indirectly. As gold's monetary role expands, capital that cannot afford gold's higher entry price often turns to silver as an accessible alternative. Fourth, consider the cryptocurrency dimension. Bitcoin was designed to serve as digital gold, a decentralized, scarce asset outside government control. It has succeeded in capturing imagination and capital. But Bitcoin's volatility and its correlation with risk assets during stress events have exposed limitations. When Silicon Valley Bank collapsed in March 2023, Bitcoin did rally. But gold rallied more consistently, and without the drawdowns Bitcoin experienced in prior months. This revealed something important. In genuine crisis conditions, capital still flows toward the asset with 5,000 years of proven history. This does not mean crypto is irrelevant. Bitcoin and Ethereum serve important functions in a digital economy. Stablecoins have become essential infrastructure for global payments. But crypto complements precious metals rather than replacing them. Investors increasingly understand this. Diversified portfolios now include both digital assets and physical metals. Silver, with its lower price point and industrial demand story, attracts investors who want exposure to hard assets without concentrating entirely in gold. Now the practical question. What should an investor do with this information? The first principle is honesty about risk tolerance. Silver is not a gentle asset. It does not provide the steady, modest returns of a diversified bond portfolio. It moves in violent cycles that test psychological resolve. If you cannot watch your position decline 30% without panic selling, silver is not appropriate for you. If you bought at $70 and sold at $55 because the volatility became unbearable, you have already demonstrated that silver exceeds your risk capacity. This is not an insult, it is reality. Every investor has limits, and knowing those limits before entering a position is essential. The second principle is position sizing. Silver should not represent your entire portfolio. It should represent a slice, perhaps 5 to 15%, size such that even a significant drawdown does not impair your financial stability or emotional well-being. Position sizing is how professionals survive volatile markets. They make bets sized appropriately for the risk involved. When they are right, they profit. When they are wrong, they survive to trade another day. The third principle is thesis awareness. You should be able to articulate in one sentence why you own silver. Perhaps your sentence is, I own silver because the monetary system is debasing currency while industrial demand structurally increases. Perhaps your sentence is different. But if you cannot articulate a sentence at all, if you own silver simply because someone told you to, you are not investing. You are gambling. Looking forward, several scenarios deserve attention. In the bullish scenario, gold continues higher as central banks accumulate, and the Federal Reserve eventually cuts rates to prevent fiscal crisis. Silver follows with leverage, potentially reaching $100 per ounce or beyond. Industrial demand from solar and electric vehicles provides fundamental support. The gold-to-silver ratio compresses toward historical norms, accelerating silver's relative gains. In the bearish scenario, deflationary forces emerge as credit contracts and recession deepens. Risk assets decline across the board, and silver initially falls with them due to its industrial exposure. Only later, as policy response becomes inflationary, do metals recover. Investors who entered at high prices face extended drawdown periods. In the base case scenario, silver consolidates its recent gains, trading in a volatile range while the market absorbs the speculative excess from the run to $80. Gradual accumulation by patient investors builds a foundation for the next leg higher. Time becomes the cost of holding a thesis that takes longer to unfold than expected. Each scenario is plausible. Assigning probabilities is the work of individual analysis. But the key insight is that all three scenarios eventually favor metals if your time horizon extends beyond the next quarter. There is one more element that demands attention: the psychology of holding winners. Many investors who purchased silver in the mid-20s now hold positions with extraordinary gains. This creates a psychological trap. The fear of losing unrealized profit can become more intense than the fear of actual loss. Investors find themselves checking prices obsessively, reacting to every fluctuation, losing sleep over paper gains that were supposed to provide security. This is where discipline matters most. If you have a process, follow it. If your process says to sell a portion at certain levels, do so without regret. If your process says to hold through volatility, then hold without second-guessing every red candle. The market punishes improvisation under pressure. It rewards those who make decisions when calm and execute those decisions when chaos arrives. Silver has shown its hand. It can sprint when conditions align, and it can collapse when speculation overextends. Both movements are features, not bugs. This is how silver has always behaved. The question is not whether silver will be volatile. It will. The question is whether the underlying thesis, monetary debasement, industrial demand, geopolitical fragmentation, remains intact. By every measurable standard, it does. Gold continues accumulating institutional support. Central banks continue buying at historic rates. Governments continue spending far beyond their means. Industrial demand for silver continues growing with electrification. These are not conditions that suggest the precious metals bull market has ended. These are conditions that suggest the bull market is still maturing. The rapid pullback from $80 was not the end. It was a test of conviction, a test of positioning, a test of whether holders understood why they owned what they owned. Those who passed the test still hold. Those who failed the test sold near the lows and now watch from the sidelines, hoping for another entry that may or may not arrive at convenient prices. The market does not care about convenience. It only cares about preparation. Prepare accordingly, position appropriately, and remember that the greatest gains in history were earned by those who stayed when everyone else fled. This is not the end of the silver story. It is the middle, and the middle is where patience creates wealth.